What's going on, guys? Welcome to another session with me, Ross-rfx. In this session, we are going to be talking about how to read major order flow and understand the individual range dynamics. Now, this may sound confusing to some and it may seem complex in a way, but it's really not. It's just having a very consistent understanding of probabilities within your major order flow. Again, this is only going to be understandable if you have watched the first video, which is how to read major order flow within the 5-minute time frame. In that video, we explain to you how you determine your points in price and how each point within price can be located to determine your range. We then wait for these points to be invalidated before determining your next spot and continually reading this order flow to develop an understanding of directional order flow within the market, to then use the same principles to identify manipulation points or swing points within the market. In today's session, we're going to talk about these individual ranges and the principles within them that you need to be looking at, taking note of, and applying when you are following and reading this major order flow. First things first, when we have established major order flow, okay, so we've established a directional move. Now, in this case, we're just going to draw a downwards move. We have to establish what these ranges are doing collectively. The purpose. What is the purpose of reading major order flow? Well, the purpose is to have an understanding of what price is most likely to do in direction with the higher time frames. But to first understand this, we need to be able to understand these ranges themselves, because they each hold a little bit of value that you need to make sure that you're paying attention to. Now, that main element is to work out how each range is going to affect or put in place certain points within the market, okay? Now, what do I mean when I say this? Well, what I mean is, if we create, for example, a very oversized range, we in turn can have multiple, which again, this is something it will take time, multiple 5-minute ranges, quotation marks being used, which may throw off a lot of people. Now, the reason I say this is because skim read the 5-minute order flow rather than reading it with true depth and, again, understanding, looking at the individual range, working out how their traits and their overall principles are affecting given aspects of the market. Now, this is going to line up with whether you're trading them, reading them, wherever it is that you're looking at price as a whole. But what we don't want to be doing, okay, is we don't want to be reading our 5-minute order flow with the principle of looking for highs and lows, because you will find them everywhere, okay? We need to make sure we're reading the way that these ranges are playing with each other and against each other. Now, of course, they're only going to deliver with each other if order flow is successfully being given a direction, in this case down. And then once the direction changes, we know that it represents a higher time frame principle, right? Now, we will go into that higher time frame principle in this session, but we're mainly going to be focusing on the individual ranges themselves. So in this case, the main point that we're focusing on is this high to this low. Now, first things first, whenever it comes to any individual range, you must make sure that you validate your points on these ranges, okay? Now, by that, what exactly do I mean? Well, we can have a high and a low within our 5-minute range order flow, but if this high is not validated, so therefore it is not responsible for something, then it will not be the 5-minute high. The 5-minute high normally will be located somewhere else. Okay. Now, the main principles with this is we're finding, as you learned in the last session, we're finding the smaller time frame order flow investments that are giving the market its order flow structure. Remember, structure and liquidity work in unison. One of them is the cause of the movement, and the other one is the effect of the movement, right? Now, overall, when they line up, this is when we're going to start to see some very nice movements in the market. Now, first things first, having that pre-analyzed rule set for your 5-minute ranges. Now, if you haven't already, like I said, make sure you go and watch the how to read 5-minute order flow, as it's going to be essential for your understanding of this principle. So first things first, we must make sure that the range high to low that we have come from is valid itself. Okay, this is why it always helps to start at a manipulation point, because you know that that point is a bearish to bullish order flow, for example. So you know from here, as soon as we've broken and generated our manipulation point low, if we're traveling high from here, we can say, okay, well, this is the last high, this is where we broke it. We can locate our last low, locate our last high, and then we know that we are tracking structure in line with the order flow and not tracking it skewed. Now, how can we track it skewed? Well, for example, if we look at this right here, let's say that we didn't take into consideration this high and we marked a high that was down here, which we know, again, from the previous session that we hosted, we know that this is not going to be the valid high, because the high has to be situated above and before contact of our last low if we are taking lows, and again of the high if we're taking highs. So if we had not paid attention to this principle and we highlighted a high that was, say, here, this would bring our high down, and it would also give you a structural shift. It would give you a shift in narrative, because now you would have, in theory, a bullish 5-minute range, then another bullish 5-minute range, and then you'd be waiting for price to go bullish again. When if we applied our principles properly and thoroughly looked at them, we would know that we are playing within a larger 5-minute range, and that overall, until we break out of this, we do not change our directional bias. Again, this is where price can really catch some people out, because it's all down to what I like to call an anchor point. An anchor point is a point in price that you will establish your analysis from. This is why I said a manipulation point, because it's a very clear shift in order flow from one direction to another, so it allows you to follow from that directional shift, knowing that you have tracked your work from the previous points. Therefore, you're not going to be tracking invalid structure, you're going to be tracking valid structure, right? So if we are not tracking the structures properly, you're going to have invalidations when it comes to your analysis. So you're going to be tracking a bullish order flow movement, which truly is still just playing within the previous high and the previous low. Okay, now this is what we would refer to as internal price action. Now, it's important to know the internal price action from the external price action, because if you're tracking internal price action, you're going to be tracking short-term, non-consistent movements within a more consistent directional range, which in turn will sit within a larger directional range, right? That's where the fractal nature of the market comes from. Remember, fractal as a whole, if you don't understand, there are two different terms. You have fractal equations, which will give you a systematic equation of a fractal sum. And then you have the definition of fractal, which is continually smaller structures that present the same characteristics and hold the same values within them. Okay, no mathematics needed, as long as we have the same principles, same structure, and same narrative. So it's exactly what I was saying earlier, where we have larger 5-minute order flow, then we have internal order flow within that range. And this is where we're going to start to work on the understanding of range dynamics. So whenever we have a 5-minute major high and a 5-minute major low, as long as our structural point and our anchor point is correct, we can begin to work out the probable area for a reversal to happen within these structures. Now remember, if price is traveling down, for example, in a major order flow direction, that is the direction we'd expect price to continue traveling in. Now, of course, that is always going to come with an if and a but. And again, those ifs and buts are found in the how to read manipulation points and understand swing points video, because that is the higher time frame version of this session that you're watching right now. And it is going to define your higher time frame direction. So if you are tracking structure that is within, let's say, a larger time frame bullish directional move, then your favorable direction is going to be bullish, and we should be looking for our 5-minute internal order flow to line up with that narrative, not to trade internally against this narrative. So if we have a higher time frame bias of bullish, which is, let's say, here to here, we have this low at this point, and we have a high at this point, and this is all internal price action here, right? We would pretty much want to dismiss the bearish internal price action. The point that we want to be paying attention to is the point where price shifts back into the bullish directional movement. Again, this is not a trading system. This is not a enter here if you see this explanation. This is a how to understand the dynamics of these ranges, the ranges that you're reading to determine your directional order flow and your manipulation and swing points. Now, whenever you have a larger time frame bias, you have to make sure you listen to it, which again is going to fall into the same thing that we spoke about here with the 5-minute order flow, because this is a higher time frame bias to your internal price action. Now, if you've seen the framework video, you will know exactly why I'm drawing these boxes, because you have an internal framework to an external framework, and they all have their own job to play in the overall market delivery. Okay, remember, the market is looking for efficiencies to be inefficiencies to be cleared and efficiency to be created, giving that balance of one-to-one trading. Now, because we have a higher time frame swing structure that we have just spoke about, we know that there is a probability that price is going to want to shift bullish at some stage. But until we actually have a solid bullish shift, we must follow the principles of these bearish ranges, okay? Now, each range, if it is a strong momentum range, is going to hold an order block. Again, most of them will sit at the high, and it's normally the last up candle before the down move. Again, this is going to be unique to each range because the level of mitigation within each range is going to determine how probable you are to see more of that order flow. Now, if that last statement that I just said seemed a bit confusing, what I mean by that is if we're having a new range, pull all the way back, drop down, new range, pull like a fair amount back, drop down, new range, pull pretty much all the way back, new range, pull all the way back. What this is doing is it's creating liquidity. And liquidity is something that generally is not going to be there for a long term. So we don't necessarily want to see every 5-minute range mitigate to the extremes. Okay? And this is where the understanding of how these ranges look is going to start to give you little cues as to what you may be seeing next in the market. So for this range right here, you can see it's clearly larger than the previous ranges. And again, we will go and show you some live chart examples of this. This is clearly larger than the other ranges, right? Which means you can expect price to want to mitigate to at least the 50% of this, right? Now, of course, this is a 5-minute high and a 5-minute low. So if you were to go down to the 1 minute, you would more than likely be able to establish 1-minute ranges within here that are giving you your pullback, so on, and you'll start to realize it is just a miniature version of your swing ranges, just presented again within another range, within a range, within a range, therefore giving you your multi-level packed ranges. If you're seeing a 5-minute high and a 5-minute low, and you have validated and you're sure that you have validated the low point that you have broken, the high point responsible for breaking that, and then the newly established low, then we can begin to identify the area that we want price to pull back into. And again, this is not for trading. If you want to know how to trade these ranges, go and look at the 5-minute ranged video. That will lead you into more of a trading system. This is more of an understanding. When you have these ranges, you're looking for a pullback. Now, what you really want to establish, okay, is how well that range has been mitigated prior to creating and moving on to the next. Now, if we have a large range like this, if we pull back and we go all the way down and we run the low, beautiful. It could be a 5-minute range trade and it could be absolutely beautiful. But really what we want to be seeing, if we are trying to identify a point for the higher time frame order flow to begin aligning with what we have already, we need to have a reasonably unmitigated, strong 5-minute range. Now, what does a reasonably strong 5-minute unmitigated range look like? Well, it's pretty simple. What does a strong range look like? We know that it needs to have imbalance. We need to see imbalance within these areas, right? We know that we want to see unmitigated order blocks. We know that we want to see essentially some internal highs here being swept out, giving this a high value or a protection of some levels. We then realistically want to see price pulling back to around the 50%, but not mitigating fully. Okay. Now, why is this? Why do we want to see it not mitigated fully? Well, we want to see 5-minute ranges mitigated and price continue in that direction. But if we're starting to line this up with a higher time frame order flow, and the higher time frame order flow, as stated earlier, is bullish, which is actually the opposite to this, we want to use these attributes of these ranges and these essentially principles that the ranges hold as indication of order flow shift. Okay. Now remember, we are internal. So when we're internal to a swing range, the bias is in line with the swing range. When we are external to that, it changes the narrative again. That is going to be in a different video. This principle and this understanding lines up with internal and external. But if we're already within a range, we know what direction we want the market to shift in. Okay, so we don't want to be rooting for pull back, drop away, pull back, drop away, pull back, drop away. What we want to be doing is looking for a clear shift in these directional movements, giving you the order flow shift that you are looking for. If we have unmitigated price action within here, so we have an order block and imbalance, we're looking for a pullback that holds relative efficiency without being completely efficient. Okay, so that would be pulling back to around the 50 without pulling back into the imbalance and into the order block. Now, if this area itself becomes a new range, for example, and it breaks down the low, we can look at this and say to ourselves, right, well, we have an area above this range which holds X amount of liquidity, right? We know that this area needs to be mitigated. So if we do pull back and break out of this range against the order flow direction, we can use this area as a good cue whether we are going to continue in the counter order flow direction, but pro trend. So trend, and then this is order flow. So order flow is down, trend is up. So if we break one range, we don't want to go, whoa, we broke our first range, bullish, stop loss under the low, full margin, off we go. We don't want to do that. Why? Because then we're not giving any confluence behind our idea that the whole order flow within a high time frame range has changed. Now, of course, there are methods that you can use to trade the first range, but again, we're not going to be talking about those in this video. So at this point, we have a clear range that essentially has failed. We've had bearish order flow until this point. So from here, we are looking for now the next range to clear this area. Now, it is completely fine if we push into here, pull back, so the new range will be here to here, and then we go, right? That's completely fine. What we don't want to be seeing, and what you will see, again, we'll show you this, what you will see is price pulling into these areas and then going bearish again, okay? Giving you a swing high, swing low, break of those structures, and moving again in a different direction. In this principle, like I say, we are within a bullish overall range, so this bullish movement would give us a slightly different scenario sitting within the swing. We see a bullish move, it means we can trade it, like I say. We're going to do a different video on trading ranges within the higher time frame swing structures. So from this point, we're using the dynamic interaction between this sell-off move and this buy move. Yeah, we're using the interaction between these 2 points in market to determine an area within the pre-created order flow that is going to give us a strong indication of trend alignment. Okay? Now, if we don't get a strong indication of trend alignment, just expect the bearish price action to continue. You're going to hit a higher time frame order block or liquidity point at some stage, and the overall higher time frame trend will continue. So remember, like I said, we are within a swing range here. We need to be looking at the characteristics of each range and the way that they play within each other and lock into the overall structural narrative of price. So now that we've had a good old draw and we've spoke about this, we're going to go down to the live charts, and I'm going to show you the 5-minute ranges and the way that they can behave and how we need to read the very clear and simple attributes of these ranges to then determine probability of expansion or reversals. Right guys, so we are now down on the live price charts. Now you can see from what I have marked here that we are tracking our swing high, swing low, or our manipulation points, whatever you prefer to call them. And within these points, I have highlighted the ranges. Now these green and red boxes that we have here, these represent the ranges and the structured moves within the 5-minute order flow. The reason they are boxed off is because it gives you a clear high and low, and you can see where price closes outside of that point. So for example, we have a high that was established here, the low is established here, and we do not break until we close outside right here, and then we put in a new high and a new low, and so on until we break here. Okay, and then we have our first bearish ranges within here, then we have 2 more bullish ranges, then we have our big bearish range. Now first of all, before we talk about this is of course, as I said earlier, going to be very important when it comes to the understanding of how this range principle is going to come into play and actually be useful for you in the real world scenarios. And that is because you're going to have to line them up with higher time frame shifts. Okay, and these higher time frame shifts are the manipulation points and swing points within the ranges. If you're looking at these movements here, you're looking at the principles that we have in price right now. We know if we put in a swing high and we put in a swing low after breaking a previous swing high, so exactly what you've seen here, previous swing high, we've broke it, put in a swing high, and we have already confirmed a swing low. We know by high probability that the swing high is going to be the next point that price travels to. Of course, we can travel to the low, but it's the break of structure outside of this range which we are looking for. Look at what this range is telling us. First things first, the range is telling us that we want bullish price action, so our higher time frame is bullish. After the creation of this swing high, the internal price action goes bearish. Take a look at what we have seen right here. Now this is only price action from Monday, and it's only Wednesday now, so it was only a couple of days back that this played out. And again, you are going to see it playing out across most ranges, but the simplicity of the way it's delivered and how it looks is going to change from range to range. You're going to have to keep the structure tracking as precise as possible, and this is why I emphasize so much that if you are struggling and you aren't finding those highs and low points or tracking the ranges properly, go and rewatch those videos that talk about the basics. If you're still confused, jump in the Discord server and ask me myself during the live sessions, and we're actually hosting this session live for everybody in the server to watch along with us. Once we establish the range itself and our higher time frame bias, we know that we have a narrative to follow, and that narrative is to the upside, right? So once we've established that we have a clear low that has what within it, look at this 5-minute range and look at the overall principles within here. The high itself has actually swept a short-term high in here, but it hasn't broken structure. So we know that the high of this holds a reasonable amount of value. Okay, we have what? We have imbalance. We have unmitigated order blocks. We have all of the characteristics, including liquidity, within this range that tell us price action is very likely to go bullish if it interacts with this area. Again, that on its own is not enough. but where it is placed within the market and the swing structures, it lines up very, very nicely. If we look at what we have here, we go bullish once more. This range holds very little. It has one unmitigated order block here, which sits right at the base. We then break higher after a very shallow interaction. We break higher, giving us a new high, new low. Now this range has an unmitigated order block and imbalance. So there is a high probability that we're going to see price go bullish again after interacting with the low of this range, but we don't, we break down, which tells us that the order flow has shifted on the short term, giving us what? The swing high. Okay. Again, if you want to learn more about the manipulation points, swing structures, make sure you check out the video. It will be in the link at the end or in the description down below. Once we've established this, we now know, okay, right, let's rewind this. Let's just rewind. It's going to make things a little bit easier for us. Let's rewind. What do we have from this range right here? Well, we have a very clear swing low with a POI there. So that's perfect. Lines up with our swing range almost too well. We have a huge mass of liquidity being built across these lows here, meaning a revisit to this lower end of the range would work very well. Overall, the bullishness of this price action as it stands is an indication of what direction we want to travel in. So what we don't want to do is wait for the first range to come around and be bearish. For example, here, the first bearish range. Wait till we establish our low. There's the low right there. Do we want to be selling the market now, even though this has got unmitigated imbalance, all that kind of stuff? No. But what we do want to do is say to ourselves, right, this 5-minute range, high to low, what were the dynamics between this range and this range? Well, we had a lot of imbalance. We had quite a lot of momentum. We had some very impulsive moves. And then we had this range take it out. This range conveniently carries the same characteristics. We have imbalance, unmitigated order block. Okay, so if we pull back into the higher area here and we break down, there's a high probability that the order flow is trying to get back to where? Well, it's trying to get back to inefficiencies. It's trying to get back to rebalance the market. Now, straight away, we know what the parameters are. We know that we have a swing high or a manipulation point high. We have a swing low or a manipulation point low. So we know that we can't be external to this. So we know it's going to be somewhere within this range. Somewhere within here. Now, funnily enough, we covered the elements of these ranges before we spoke about this. And what was the only range that really stuck out enough to us for us to really highlight something? Well, it's going to be the low range, which conveniently lines up with the swing low, right? Which again adds confluence to it. So we can start to look at this and say, okay, right, we are bearish right now. Instead of jumping in being like, let's sell this, what we need to be doing is saying to ourselves, okay, where is price most likely to go? Okay, well, it's most likely to come down to here. Why? Well, we have lots of liquidity across these lows. We have lots of inefficiency at the base of this, and it's also lining up with the swing structure and swing range itself. If we do make our way back into these areas, whether it's to sweep the low, tap into the order block, fulfill the imbalance, whatever it may be, then and only then, if we start to see the same thing happening, the ranges change from bearish to bullish, so on, we can then begin to say, well, actually we have pretty much every point of this covered here, so where are we going to look to trade price? Well, we're going to look to trade it in the range direction, obviously, but we can now trade it within the 5-minute order flow, knowing that the probability tells us that we are on the right side of the market movement. Now you can see right here, what do we have here? Very little imbalance left within this sell range. No imbalance at all. So when we come up and we break out of this range, okay, right, we actually haven't broken out the range yet. Broken out the range, we establish our high, which is formed right there. Then we've already established our low, right? So again, we don't want to just go, well, we've gone bullish now, so buy it. We want to see these ranges line up with each other. So if we have a range gap here, we want a range to be established within here that hold the characteristics of this imbalance, unmitigated price action. And when we see that, we know that price has mitigated these lower areas, and it is most likely going to be rearranging the liquidity pools to aim for the high as the collective begins to lever itself round to line up with the trend rather than the short-term order flow. Remember, order flow and trend are two different things. So now that we've established that we've essentially got a small area here that may want to be fulfilled, swing high, and then we've got liquidity underneath here. I mean, we've built even more liquidity now because we've created a relative equal lows here. We can now wait for this to visit this area. Now, worst case scenario is it doesn't visit the area and it goes bullish. And you could turn around and say, well, I could have bought it here. I should have bought it. Woulda, coulda, woulda. That is not the attitude of someone that's consistently deploying a rule set, right? And of course, this video is not talking about deploying rule sets, getting into the market. It's talking about the understanding that you should have to say, yeah, well, I like this. I like what I've seen. What I'm looking for is price to mitigate this upper area, then mitigate the lower area, and then all that's left is to come and run this high. That's when you can begin to calculate your entry based off of this. Now, there is an entry here, and we're not going to cover it, but it has been given out to the VIP prior to this happening, and we also covered it in our Sunday markup, so it was there for all to see. All you needed to do was take this dynamic and understanding and apply it. So right now, we've just cleared the upper end of the range here. Now look at this. If this 5-minute range is broken, there is a high probability that we're going to visit where? Where are we going to visit if we're going bearish again here? Well, we're going to visit this lower area. Now, what is in this lower area for us? Entry models, the lower 50%, so we can just look to trade from the lower 50 of the range. There's going to be lots of different things that are going to allow us to actually get in. But now we've used the 5-minute ranges within this higher time frame structure to make a puzzle essentially make sense for us to then be able to go, that's where we want to trade from. Okay? When price comes down, it liquidates. Then, right here, I believe, oh, maybe not. Where is it? Where does it break? Right there. No. Next candle. It broke. So now it's broken down, right? It's broken down this range. Now we can say to ourselves, okay, well, we've gone bearish again. But this is the area we want price to visit. Okay? Remember, we're not looking for entries. We're looking for probabilities. We're looking for what is the dynamic of these ranges behaving together. So we've had two bearish, two bullish, another bearish. But overall, we had a very clear bullish delivery. And we've played within the high and low of this, giving us a very clear narrative of clear this space, move higher. Clear this space, move higher. The same principle that's happening within each of these ranges. So when we come down and visit this area, we of course have an entry model that we deployed here and it worked beautifully. But at this point, what have we done? Well, we've actually given a 5-minute range which has what? Has unmitigated price. It has imbalance within there. It has lots of potential to push price lower. Now, if this high is taken, there is a very high probability that we are going to continue higher. Again, this is just looking at the range understandings, not even looking at the principles of the swing high lining up with this, the entry that we're taking lining up with this, the order flow on the higher time frame lining up with this. Everything lining up with it except for the initial order flow that took us to this point. So when we play this here, our entry was given down here. You see price playing around a little bit. And then we run. Now look at this range. Okay, look at this range. Remember what we said right at the beginning. We're looking for the dynamic and the way that price interacts with each point within the range. Now, if we had imbalance, unmitigated order blocks here, would we be expecting a impulsive push through the order block? No, we wouldn't. We wouldn't be expecting that. We'd be expecting price to be rejecting, looking to go bearish again, creating a new bearish range, leading us to, in this case, a whole different trending scenario. But because we're reading the dynamics and we're understanding the principles between the higher time frame and the internal order flow, we can pretty much off the bat say if we close out above this high, like so, that this swing high is inevitably going to be hit. Because all of this lines up perfectly. Why? Well, we've had a strong mitigation of previously created structure which holds the higher time frame narrative. The internal price action has mitigated itself to the point where there was only 2 points of unmitigated price, which have now been mitigated as well. So unless it's going to keep running internal liquidity, where's it going to go? External liquidity. Now notice what this is here. And I want you guys to pay attention to this. It may be a swing low and a swing high with a load of highlighter and green boxes all over it. But what it is, in principle, it's a higher time frame 5-minute range. It's a higher time frame 5-minute range that essentially has pulled back to fully mitigate, and then it's looking to extend higher. It is nothing more, it is nothing less. And this is why I say to you, you must understand these principles to be able to trade within these parameters. If we look at this in the diagram perspective, it brings us back to the same model that we looked at the very beginning, which is a high point and a low point. Price delivering, pulling back, and continuing. Okay, with its own independent, smaller time frame ranges within here, which tell the story of that range mitigation and of the way that that range is moving overall. So remember, every single swing range that you're within holds your higher time frame directional bias and narrative. Each 5-minute range that created it tells a story and where price is most likely to revisit, and the internal price action will also give you a very nice understanding, if you read them and watch what they're telling you, as to where price may want to go and where price is very likely to go. So as always guys, if this video has helped you understand the principles that we are teaching you, make sure you leave us a comment down below, make sure you hit that like button, and of course if you want to be a part of the Discord family, then the link for that is down below, where we host live sessions almost every day, and we host events like this where you get the opportunity to ask questions afterwards. And as well, if you are confused at these principles and you're looking at the screen thinking, what is this guy talking about, make sure that you have watched the previous released videos that we've dropped on this topic. Apart from that guys, I hope you all stay safe, trade your plan, and I will catch you in the next video. Peace.